You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so last week we did a very short-term trade. Talked a lot about where the VIX was at relative to the S&P 500 index. The fact that we were above the 30 handle last week. We decided that we were going to do a very short-term butterfly that should have worked out just fine, as a matter of fact. When we looked at doing the butterfly, the markets were live. It was in the morning of June 16th. We had the market at 36.68. We're going to round off a little bit because the markets were rocking and rolling while we were doing the podcast last week. And we were just going to be a little bit bearish for one day. So we bought the 36.75 put, sold two of the 36.55 puts, and bought one of the 36.35 puts. That trade was done for somewhere around $1.65 if we could trade it at that midpoint. I talked about the fact that the only reason why a 20-point wide butterfly with only one, well, I guess approximately 2 days left in the life of those option contracts, because we did tape in the morning on June 16th. Could trade for 165 as if the VIX was elevated and volatilities were elevated, and they were. So $1.65 was the total risk, or $165 for every 1x2x1 butterfly. Now, you could have probably even closed it out by the end of the day on the 17th, because the market did hang within those strikes and within that range. But if you stuck around till Friday, which is more than likely what I would have done on the trade, on Friday, the close was 36.74, which is right where that high put strike was, 36.75. That was our most expensive put that we were using on that day. And if we did that trade at some point in time during the day, there were many opportunities to get out. The low was 36.36, closed at 36.75. It hung around the 36.55, which is, basically the home run. That's where we wanted it to be. It touched that short strike many times. So I would have considered getting out at almost any point in time. I'm sure you could have easily doubled it, maybe tripled it. If you waited all the way to the expiration, well, the joke's on you a little bit, because at expiration, it closed right at the long strike. So that would have been a bad scenario. And you definitely would have got the stupid award for that, because Why not close it while it was sitting close to the 36.55 with, let's say, a half a day left in trading until that expiration of those option contracts? So that one was simple. We talked about an adjustment on the trade. You never would have had to do it based off of what the chart looked like. So this week, let's continue to be bearish. Not a lot of people have been focused on meme stocks. As a matter of fact, some of the meme stocks have, in this downturn, actually had days where they did better than most of the marketplace. But I think it's time to get short. We're going to continue to be short here on Options Playbook Radio, just over the near term. We've talked about a lot of more bullish strategies. And in this marketplace, it is much harder to pick underlyings to trade on. So I, once again, am not really making a forecast per se on the underlying stock, but I like the way the option prices are. And to lean bearish in AMC using a long put spread, I don't mind the risk reward ratio. And once that's what Options Playbook Radio is all about. We're trying to find conditions on the underlying where this strategy may be better than that strategy. Last week, we looked at a butterfly. Why? Because butterflies were cheap, because VIX was up over the 30 handle. And that made that butterfly cheap. So we did a one-day butterfly that worked out on paper. Now, this week, we're going to look at AMC. I think that, there's been a rude awakening for a lot of the meme stocks, but I still think that there could be potentially some downside. But more importantly, I wanted to go and look at what's going on with the option skew. What is going on with the pricing of the option contracts, because they've been crazy for a long, long time. As a matter of fact, I remember talking to a reporter when the meme stock, when basically that word was created, meme stocks, and just looking at the chains, the markets had ran up and they were going back down. And the reporter asked, well, does this mean that this is over? And I said, well, I don't know for sure if it's over. Once again, I'm not a stock analyst per se. I'm an option trader. I trade prices and probabilities more than I do the fundamentals of a company. But the option marketplace says that it's not, just because of the way people are willing to pay up for way out of the money calls. And that happened to be true. The market had more than one run to the upside and then another dip to the downside on a lot of the stocks like AMC, GameStop. Those are two of the biggest ones that they had a lot of activity on. But it was pretty obvious from looking at the option prices that the marketplace did not think that it was over, right? Because of what they had to adjust the options for the type of trading that was coming into the marketplace. So in this instance on AMC, if I look at the July 8th calls, we're only going to go out 16 days. We're going out over the holiday. If you're thinking of this as a retail stock, a lot of people are going to go out and celebrate the 4th of July. So why not do July 8th? So there's some thinking that the holidays are coming. Maybe the stock might get ignored a little bit. And we're going to do the long put spread. So it's going to be short and sweet. I don't mind the risk reward ratio, and that's really what this is about. We see that that AMC is hard to borrow, so there still are a lot of shorts in the stock, and that has skewed volatility a little bit to the put side. We see the at the money. We'll call that the 1250 strike, because right now, if I take a snapshot, the markets are well, actually they're just closed. As a matter of fact, we're taping at 4:04 Eastern time, so the market has closed. So with that said, AMC is at 1253. The 1250 strike, we see the ask is at 122 on the call and 129 on the put. The put implied volatility is at 122%, and the call implied volatility is at 112%. When you see a skewing in implied volatility, that usually has to do with hard to borrow and just the way the models are calculating it. Okay. So the expected move here it would be a little less than $3. So we're gonna use that information, and we're going to buy something as far as the long spread is concerned. We're going to buy some strikes that have the potential to happen based off of the expected move. So the put that we're going to sell here is going to be the 11 strike put, which is 1.5 points below where the current market is at. We're going to go a little bit in the money. We're going to buy the 13 strike put. And because of the skewing, because of the fact that the implied volatilities are higher on the out of the money puts, we can actually buy the 13 strike put, sell the 11 strike put with the July 8th expiration, and we can get this done for a 97-cent net debit to the account. So we're able to do this for, we have a 2-point wide put spread, and we're able to get it done for $1. So we're risking $1 to make $1. The expected move is much higher than going all the way down to the 11 handle. Now, obviously, expected move has nothing to do with direction, but it's saying that the potential for it to go down a few points is possible as much as it is to go up a few points. So we're going to be risking $1 to try to make $1. We're going to do this over the July holiday. Very short, very sweet, long put spread. And a lot of times if I'm on the bear side, I'm usually going to be a little bit more short term, just like we were last week in the S&P 500 index. Don't ever know when the exact bounce is going to happen. The July 8th expiration has 16 days remaining until that expiration date. So last recap here, AMC, we're going to get bearish with a long put spread. We're looking at the July 8th expiration. We're going to be buying the 13 strike put, selling the 11 strike put. Doing this for a net debit at the midpoint of 97 cents plus commissions. Basically risking $1 to try to make $1 by that July 8th expiration. All right, that's it for this episode of Options Playbook Radio. If you'd like to learn more about what we do at Ally Invest, please follow me on Twitter. My handle is @BrianOverby, at my name, very, very simple. And as always, if you would like to send us an email, myself and Mark Longo like to do huddle ups and we like to try to answer as many questions as we can at those huddle ups. So thanks for listening. See you at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.